1971 to 1980, gold went up 2,300%. Now, that's the dollar price of gold. But do the inverse. So what happened to the dollar in that time period? Well, the answer is it went down 97% relative to the weight of gold. There's your crash. People don't look at it. They don't look at that number. But the dollar actually did collapse, not against Deutschmarks or French francs or Swiss francs at the time, but against gold. If that happened again, I'm not forecasting this, but if that happened again in the same percentage move, gold would be $100,000 an ounce.
Gold is entering the new week with a lot going on behind the scenes. Over the past couple of weeks, price has been stuck in a tight range around $4,800 to $4,850, but that doesn't mean nothing is happening. The market is experiencing an interesting tug of war at the moment. On one hand, there is an increased risk of political unrest in the Middle East, particularly concerning the Strait of Hormuz, that is sustaining demand for gold. Prominent gold bull and economist Jim Rickards predicts that gold is on track to rise toward $100,000 per ounce, and he believes the move could happen much faster than many expect. Looking at historical precedent, he recalls that gold rose dramatically during the 1970s as confidence in the dollar weakened, and he argues that a similar loss of purchasing power could send gold far higher in the years ahead, reinforcing his long-term bullish outlook on precious metals. Based on fundamentals, Jim Rickards explains that although the U.S. holds large gold reserves, much of it can be leased on paper to banks, allowing multiple claims on the same gold through rehypothecation. This results in far more paper gold than actual physical supply. In his analysis, the U.S. Treasury's gold holdings could also be revalued far above their outdated official book price, instantly creating enormous accounting gains for the government without issuing new debt. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from Jim Rickards' recent interview.
About 5 or 6 months ago, Elon Musk and Donald Trump were going to go to Fort Knox, take a camera crew, and find the gold. They were going to look at the gold. And of course, the implication was maybe it's not there. The gold is there, rest assured. It's actually half of it's in Fort Knox. The other half is at West Point at a vault. I happen to know where the vault is, but it's classified, so I'm not going to tell you. But it's at West Point. About 4,000 tons in each place. People always ask me, does the Fed own the gold or does the Treasury own the gold? And I tell them the Army owns the gold because these are Fort Knox and West Point are two Army forts. So what happened? They never went. Why not? Well, some people just assume, well, the gold's not there. They could. That's not true. The gold is there. They wouldn't have brought it up in the first place if they didn't know that. But that would have been such a high-profile event that it would have raised other questions. The gold's there, yes, but is it leased? And people don't understand gold leasing. They assume if JP Morgan leases gold from the U.S. Treasury, they must back up a truck and load up the gold and take it away. No, that's not how it works. It's a paper transaction. The gold stays where it is, but the Treasury can sign a contract with JP Morgan. JP Morgan pays 1 or 2% as a kind of rent, and they get that gold on paper. But with it, they get a right to rehypothecate. That means they can sell it to somebody else, unallocated. And that person can sell it to somebody else, unallocated, and so on and so on. So once JP Morgan, and I'll pick on them, could be Goldman Sachs, leases gold from the US Treasury, that gold then goes into a chain of paper transactions that could be 10 or 100 times larger than the actual amount of gold, which is still sitting in Fort Knox. They don't want to call attention to that. They don't want to have to explain that. I just did. But one of the head of commodities trading for JP Morgan for about 15 years, a lady named Blythe Master, she left the bank and got into some other things. But she made a comment once, hard to find, but I did find it. I think it's disappeared from the internet. She said, gold never settles. And what she meant by that was that the paper gold is 100 times the actual gold. And if everyone with a paper contract said, give me my gold, there's not nearly enough gold in the world, not even close, to settle those contracts. You can't settle them. What would happen is your bank would say, sorry, read the fine print, we're terminating your contract, here's a check for your gain. Like, I don't want the check, I want the gold. So, no, too bad, here's your check, you're out. And the futures exchanges would do the same thing, and so would, as I say, so would the major banks. So as long as everyone keeps rolling over and everyone's happy, that's fine, but gold never settles. If it even got close to that, the price would go to the moon. There's another factor, which is the U.S. Treasury owns the gold. How did they get the gold? How did the U.S. Treasury get all that gold? Well, the answer is they took it from the Federal Reserve in the 1930s. The Federal Reserve had taken it from the banks, and now the Treasury took it from the Fed. But the United States Constitution, Fifth Amendment, has a clause that says it is illegal, it is illegal for the government to take property from a private entity without paying fair compensation. And a friendly reminder, I'm sure you all know, the Federal Reserve is a private company. It's owned by the banks. It's not owned by the government. So when the Treasury took the gold from the Fed, they had to give the Fed something in return. And what did they give them? They gave them a little piece of paper called a gold certificate. And if you go to the Federal Reserve balance sheet, which is publicly available, it's on their website, look at the asset side. We talked about that earlier. The first line item is gold certificate, but here's the catch. That certificate is valued at $42 an ounce. If you take the book value, divide by $42 and figure out how many ounces it is and multiply it by the market price, there's approximately $1 trillion of hidden asset value. And the Treasury could, I'm not saying this will happen, but the Treasury could call the Fed and say, mark it up to $4,000 an ounce. And the Fed would do it, and they would put $1 trillion in the Treasury's account. Now, a lot of people look at that and say, well, doesn't that mean the price of gold has gone to the moon? No, it's an accounting entry. And the government would get $1 trillion of spending money without issuing any new debt. But my point is different, which is if the Treasury did that, again, kind of like Elon Musk going to Fort Knox, it would call attention to gold. I've spoken to Ben Bernanke, I've spoken to Paul Volcker, I've spoken to a lot of officials about this. They understand what we understand. They understand gold is a valuable monetary asset, but they don't want to talk about it. They don't want to call attention to it. And that's why you don't see some of these things that we mentioned. So just very briefly to wrap up, gold will go to $10,000 an ounce in 2026. And a lot of people, $10,000 or higher numbers, et cetera. I've said it for a while, but it's kind of a commonplace prediction. But what I would add to that for your benefit is that's going to happen a lot faster than people realize. And the reason I like to keep the math at the 5th grade level, at least when I went to school, we don't need calculus for this. So gold took a while for gold to go from $2,000 an ounce to $3,000 an ounce. But that's a 50% gain. There's a phenomenon called, it's a behavioral psychology bias. It's called anchoring. We get a number in our heads, we get an idea in our heads, and we anchor on it, and we filter all the information through that anchor, whatever that psychological anchor is. So people, if you have 50 ounces of gold and it goes up $1,000, you made $50,000. If it goes up another $1,000, you made another $50,000. That's true. And so you get that $1,000 anchor in your head. But when you go from 2,000 to 3,000, that's a 50% increase. That's a heavy lift. When you go from 4,000 to 5,000, that's a 25% increase. It's still a pretty big move. But when you go from 9,000 to 10,000, that's only 11%. That's like a good month, the way gold has been trading lately. My point is the $1,000 gain is the same, and your $50,000 profit, in my example, is the same. But each $1,000 leap is easier than the one before because you're working off a higher base, and it's a smaller percentage gain. So what's going to happen is gold will make its way to 5,000. It might not take that long and kind of make its way to 6,000, but you're going to go 7, 8, 9, 10 really fast. And people say to me all the time, hey, Jim, you said buy gold. Actually, I started when it was $700 an ounce. I have friends who bought it at $200. Good for them. But the point being, I didn't do it. I didn't listen. I didn't buy enough, and I missed the boat. I missed the market. I say, no, you didn't. You missed a couple $1,000, but there's a lot more to come. It's going to go to $10,000. And so it's not too late. Not only is it not too late to buy it, this is a very good time to get in. And one last thing, and then I'm done. 1971 to 1980, gold went up 2,300%. Now, that's the dollar price of gold. But do the inverse. So what happened to the dollar in that time period? Well, the answer is it went down 97% relative to the weight of gold. There's your crash. People don't look at it. They don't look at that number. But the dollar actually did collapse, not against Deutschmarks or French francs or Swiss francs at the time, but against gold. If that happened again, I'm not forecasting this, but if that happened again in the same percentage move, gold would be $100,000 an ounce.
Regarding the global monetary shift, during the interview, Jim Rickards explains that while a formal BRICS currency may take years to develop, the bloc is already operating with an alternative system where gold effectively acts as a common settlement asset. He mentions that countries like China and Russia are increasingly trading without the US dollar. using local currencies and periodically settling imbalances in gold. This system allows them to bypass Western financial infrastructure, weakening the dollar's dominance over time. At the same time, central banks have turned into major net buyers of gold, creating a strong structural floor under prices. Rickards describes gold not just as an inflation hedge, but as an everything hedge, performing well during inflation, deflation, and periods of geopolitical instability. Gold is sitting near $4,850 per ounce right now, and BRICS buying gold is a big reason why. BRICS gold reserves have grown from 11.2% of global holdings in 2019 to 17.4% as of April 2026, per World Gold Council data, and the pace has only picked up. De-dollarization and gold accumulation are moving together, and the early stages of a BRICS gold-backed currency, called the unit, are adding fuel to it. Let's jump into the interview.
The other part of the narrative, what's the other part of the narrative? The BRICS are going to have a new currency. BRICS, Brazil, Russia, India, China, South Africa. There are about 10 other members, by the way. They've expanded the BRICS. There are 17 nations on the waiting list who will be admitted to the BRICS over time. The BRICS have the potential to have a free trade area. Perhaps they'll have their own currency in 10 years. I worked on the creation of the euro with partners. Alberto Giovannini is a prominent Italian economist. That took 10 years. The Maastricht Treaty was signed in 1991, and the euro was launched on a wholesale basis in 2000. It took 10 years of pretty hard work to create the euro. Why should the BRICS be able to do it in 2 years? Well, they won't. Maybe 10 years, but probably not. But my point is that the BRICS already have a currency. They have a common currency. It's gold. So I'll just take Russia and China as two examples. Russia sells oil and natural gas to China. China sells manufactured goods and semiconductors to Russia. Russia pays in rubles. China pays in yuan. There are no dollars involved. What they have done, they haven't come up with a new currency, but they've come up with a new payment system, new rails, fiber optic cable, clearinghouses, et cetera, all to avoid U.S. sanctions. And I teach at the United States Army War College, and I explain to them that these sanctions don't work. They haven't stopped Russia from doing a thing. They hurt the United States more. But the point being, the BRICS have come up with an alternative global payment system, and that's very important. Well, how do you settle that up? I mean, how many yuan does Russia need, or how many rubles does China need? Well, maybe not that many, but you can settle it up periodically, and you can do it. You don't have to do it on a gross basis. You can do it on a net basis. So I owe you something, you owe me something. We net them out. We only have to settle up the net. We don't have to do it in real time. We can do it quarterly, and we can do it in gold. So remember, there are no dollars in the system I mentioned. That's the system that is entirely feasible for the BRICS right now. You hear about the Chinese they're buying all this gold. They're going to have a gold-backed yuan. No, they're not. They might have. They report they have about 2,600 metric tons. It's only a quarter of the United States. I'm quite sure they have more. They're non-transparent about it. But even if you doubled or tripled that number and got up to 6,000 or 7,000 metric tons, or perhaps even higher, their money supply is bigger than the U.S. money supply. People complain about the Fed all the time. Chinese have printed even more money. They don't have, their gold as a percentage of their money supply might be 2%. You need about 40% gold to have a good gold-backed currency or gold standard. So that's not going to happen. The debasement trade is not true. That's, the dollars. Everyone's going to get out of the dollar. Really? If you're going to get out of the dollar, you're going to buy the euro? Japanese yen? I mean, do you like that better? I mean, you have to think about that. And there's only one market in the world, big enough, liquid enough, and with a good rule of law. And that's important, the rule of law, to absorb global savings, and that's the U.S. Treasury market. So in the short run, there's not going to be any kind of global reset, except in one category, the dollar price of gold. That gold is it's a form of money, but it's not a currency. And the dollar price of gold, when you want to see the crash and collapse of the dollar, don't look at the euro, don't look at the bond market, don't look at interest rates, look at gold. And that's where you'll see the crash play out in real time. Okay, so that's the mainstream narrative. None of it's true. But what is true? What is actually driving the price of gold? A couple things. Number one, central banks are net buyers. From 1970 to 2010, they were net sellers of gold, and you could argue they were suppressing the price. Perhaps they did. Beginning in 2010, central banks are net buyers, and that buying is increasing. It's going up at a faster tempo. Not the same central banks who were the sellers, the US and UK and Australia and Switzerland and others were the sellers prior to 2010. Today, the buyers are Russia, China, Kazakhstan, Philippines, Vietnam, believe it or not, buys a lot of gold, Mexico and others. But it doesn't matter if you're a gold investor. The fact that there's net buying, that tends to drive the price up. We see tokenized gold. Tether is the most prominent, but there will be others. These are kind of stable coins where you give $1, but instead of just getting $1's worth of Tether, you get a coin that has a certain amount of gold associated with it, whatever the market price is. And your dollar value goes up or down with the price of gold. It's a way to get price exposure. But the point is, the sponsor of the gold tokenized coin is going to buy that gold and hold it. They're not hedge funds that dump it. They don't cut and run. They're going to hold on to that gold. Same with the central banks. So whenever you have buyers who not only buy gold, that's important, but they hold on to it. They don't trade it and they don't sell it. That gives you a kind of floor, not a guarantee, but a kind of floor under the price of gold, which is what I call an asymmetric trade. When you have something giving you a floor, you have very little downside. It could go up a lot. It will go up a lot in my view, but it's not going to go down very much. That's a sweet trade because, as I say, you can make money and probably not lose very much. Mining output is flat. It's not zero. It's not going down, but it's about 4,000 metric tons per year, has been flat around that number for 6 or 7 years. I'm not talking about peak gold, but I'm saying in any world, in any market, when you have flat supply and increasing demand, what happens? Price goes up. It's as simple as that. Simple as supply and demand. The copper to gold ratio, this is a little more obscure. So what's the price of copper divided by the price of gold? That is at an all-time low, meaning, well, again, it's just simple math. It's at 6 or 7 decimal places at this point. Why is that an important indicator? Copper is an industrial metal. It's not a precious metal. It's an industrial metal. It's used in just about everything, wiring, buildings, electronics, other kinds of manufacturing, etc. It's a proxy for the manufacturing economy. Gold actually isn't good for anything except money. I think it's the best form of money, but it's not good for much else. I mean, they coat space helmets with it, and I've been to the refineries, and again, it is a form of money, but it doesn't really have any industrial uses. So the copper to gold ratio is looking at industry and the real economy relative to a safe form of money, and it's telling you something. And what it's telling you is that the economy may be weakening, and people are going to gold as a safe haven. So that's another item I watch. And gold as an inflation hedge, kind of, the correlation is a lot lower than people realize. What I say is that gold is the everything hedge. It hedges against inflation. Gold was the best performing asset in the Great Depression, the longest period of sustained deflation in U.S. history. Gold went up 75%. So gold does well in deflation and inflation. It's really a hedge against social unrest, wars, disturbance, civil wars, etc. So I by all means have it in your portfolio, but I call it the everything hedge. Someone said that gold as a percentage of total reserves has now exceeded the percentage of U.S. Treasuries. So if you look at U.S. Treasuries and gold as a percentage of total reserves, recently those lines crossed and gold now exceeds U.S. Treasuries. That's true, but there's a little less there than meets the eye. The reason for that is the price went up. It's not that everyone went out and bought truckloads of gold. It's just the price went up. So, but that's another positive factor. So that is the real narrative, but it's very favorable to an increase in price of gold.
Continued central bank buying, limited supply growth, and potential revaluation of official gold reserves could accelerate the move faster than expected. In a world facing inflation risks, currency debasement, and geopolitical fragmentation, gold appears positioned not just as a hedge, but as a central pillar of the next financial era. Long-term gold price projections for 2030 are widely bullish, with forecasts often ranging between $6,200 to $10,000 per ounce, driven by structural demand, geopolitical risks, and central bank reserve expansion. Aggressive predictions suggest higher, while conservative scenarios suggest gold remains a safe haven asset with steadier, moderate growth. As gold demand rises and global systems shift away from the dollar, could this be the early stage of a historic revaluation in precious metals that reshapes the entire financial system? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.